people in Vegas say, let me lose my money like a man. But, Scott, one of the issues here is that an awful lot of those trades that you and Kate described, whether it's AMC, which I'm in, or GameStop, which I'm in, or Express, or any of these other companies, are being made in the derivatives market. That means, of course, calls and in some cases puts. Now, if you buy a call option, of course, you can convert it into stock. You call that an exercise. You exercise your right to buy the stock. Now, in many cases, I'm not saying all, but in many cases, the people who have these now deep in the money calls in any of those names, Scott, do not have the capital in their accounts to basically turn a $5 option, a $20 option into a $275 stock, because 1,000 shares of a $270 stock, you and I know, $270,000. They don't have that. So instead, what they're having to do, Scott, is they're selling in-the-money calls against their positions. Not all of them, but a lot. And when we see that, they are selling these options below parity. Parity, of course, is if I have a 100-strike call and the stock's trading at 200, and I have to sell that option for like $70, that's $30 under its intrinsic or in-the-money value. And that's happening across the board in these big stocks, again, because the people who own those options can't afford to turn them into stock. So instead, they're selling that option or another option, and that selling process is pushing those options below parity. It's like free money. It never happens on Wall Street, but it's happening right now. And TD Ameritrade, I'm guessing, I haven't spoken to anybody there, but I'm guessing that they're trying to keep these people, Scott, from basically losing too much money on exactly that process. They're giving away hundreds and thousands and millions of dollars by selling these calls below parity.
Well, and you know, some of these firms, and TD Ameritrade is probably not the only one that is now has a 100% margin requirement. John, to your point on GameStop. Joe Terranova, just give me your thoughts. Doc, I want to get back to you because you said something in there that I think a lot of people, caught, that you're involved in GameStop, and I do want to talk to you about that. But Joe Terranova, your reaction as you're watching all of this occur today.
This is a classic example of an extension of leverage that has not been properly regulated. TD Ameritrade, congratulations to all of the online platforms. What took you so long? To the regulators themselves. What allowed you, in the environment that we have been in 2020, for whether it's a hedge fund, an individual, or an entity, to be able to short against the entire float of a stock? There's no reason behind that. So the leverage aspect of this, you still have people that are able to deposit $50,000 in an account and go sell Best Buy, which is trading right now at $48, and sell 2,000 shares of it. Well, if that stock rallies $30, you're out your money. We're not properly monitoring leverage. That's the problem here. We're not properly placing guardrails in place. We've got these circuit breakers, Scott. What are the point of these circuit breakers? The circuit breakers, they shut off at 4 o'clock. Why? Why are there no circuit breakers in the extended hours? We have circuit breakers for futures. So I have a little bit of a different take on all of this than I did on Monday, because on Monday I was concerned when I saw a 159 print for GameStop 48 minutes before we went on air, and now I saw an 80 print while we're on air. We have new people finally participating in the market. I don't want them to leave. I want them to be educated. I want them to participate. They are the future of the markets. But we have to make sure that we ensure the environment for these individuals. And right now what you have going on is a classic example of you've got retail investors, but you have Silicon Valley battling it out with hedge funds. And what has evolved from that is that there's an actual strategy in the market that's being implemented. It's all the small cap stocks that have heavy short interest, and they're going after them. And we saw this, by the way, in January of 2018 when hedge funds implemented the volatility strategy of being short volatility. Does everyone remember what happened over that week when the short vol trade blew out? So the short squeeze trade from hedge funds is blowing out right now. That's exactly what's going on. And for the first time, it's going to impact our market,
right,
because there's going to be a need to raise capital and sell some of the winners.